Ladies and gentlemen, good day and welcome to the Suryoday Small Finance Bank Limited Q1 FY26 earnings call hosted by Arihant Capital Markets Limited. As a reminder, all participant lines will be in the listen only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Jain from Arihant Capital Markets Limited. Thank you and over to you, Mr. Harshit Jain.
Thank you. Hello. Good afternoon, everyone. Welcome to Suryoday Small Finance Bank Q1 FY26 earnings conference call. On behalf of Arihant Capital Markets Limited, I would like to thank the management of Suryoday for giving us this opportunity to host this call. Today, we have with us the entire top management team of Suryoday Small Finance Bank, represented by Mr. Bhaskar Babu Ramachandran, MD and CEO, Mr. Hemant Shah, Executive Director, Mr. Kanishka Chaudhary, CFO, and Mr. Himadri Das, IR Head. I will now hand over the call to Mr. Bhaskar Babu for his opening remarks, and then we will open the floor for Q&A session. Over to you, sir.
Q1 FY26 earnings call. We appreciate your time and interest. I hope you had a chance to review our financial results.
Sorry to interrupt, sir. We couldn't hear you. Please say again.
Can you hear us now?
Now I can hear you loud and clear.
Yeah, sorry. So I hope you had a chance to review our financial results and investor presentation, both of which are available on our website and on the stock exchanges. The bank has started quarter Q1 FY26 on a positive note in terms of the growth in advances and deposit. The growth was driven by inclusive finance disbursement, returning back to near normalcy and the significant momentum in the mortgages and the wheels business on the asset side. On the deposit side, the growth was driven by the retail franchisee as well as the digital channel. The growth in the retail franchise on the deposit side is a further step towards achieving the bank's overall mission of serving 1% of the Indian households in a meaningful manner. The NBFC MFI sector had experienced increased asset quality pressures in FY25, primarily due to borrower over-leveraging, socio-political dynamics and operational challenges, factors that have prompted the industry to strengthen its risk frameworks and operational resilience. Our bank also experienced these challenges, part of which was mitigated through the CGFMU credit guarantee cover. We are also confident that there is a huge opportunity lies in inclusive finance backed by individual loans, Vikas loan, and will continue to serve these customers in a holistic way. Also, the bank has been proactive in implementation of the MFIN Guardrails 2.0 in November 2024 itself, well ahead of the mandatory implementation timeline, and portfolio source post November 2024 have been showing better behavior either on 3 MOB, 6 MOB, etc. Also, it was a year of opportunity, particularly in the focused growth of our secured assets portfolio and the continued strengthening of our deposit franchise. Strategic initiatives undertaken in recent years, such as investing in credit guarantee mechanisms, enhancing our digital offerings across both product deposits and lending, and sharpening our focus on the MSME segment have laid a strong foundation for the coming financial year. The RBI's revised PSL norms for small finance banks have also enabled institutions like ours to build a more diversified and balanced portfolio. This progressive move opens up greater opportunities for us to focus on segments like MSME, micro-housing and other sectors, broadening our impact and reach. In respect to Suryoday's performance for Q1 FY26, I am sharing only the key highlights and not elaborate numbers in detail which have been included in the investor presentation uploaded on the stock exchanges. Our gross advances stood at 10,846 crores with a 20% year-on-year increase. Our deposit base stood at 11,312 crores, which is 39% increase year-on-year. The share of the retail deposits now stands at 82% as of June 2025, compared to 79% a year earlier, driven by the deposits garnered through the digital channels. CASA is reasonably stable at 17.7%, and we aim to reach back the 20% range in the coming quarters. Into the inclusive finance current bucket collection efficiency increased from 97.5% in April 25 to 98.4% in June 25, and the current bucket collection efficiency of the last 6 months source portfolio is at 99.5%. Our current GNPA is at 8.5% as of June 2025, and NNPA is at 5.6%. GNPA stood at rupees 918 crores and NNPA at rupees 593 crores, against which rupees 584 crore is receivable under the CGFMU scheme. In effect, the CGFMU receivable and the existing provisioning cover almost 100% of the GNPA. Some of the strategic initiatives which were initiated a couple of years back are now beginning to yield results, such as shifting from group lending to individual lending with strengthened underwriting processes, prudent risk management practices for wider coverage of cyclical events by initiating and continuing with the credit guarantee coverage for eligible loans focused on secured in retail assets business. Currently, the deposit source through the digital channel stood at rupees 1,000 crores with a daily run rate of rupees 3 crores per day on an accretion basis. The digital sourcing channel works effectively as a customer acquisition engine and also opens up opportunities and enables us to cater to the other requirements of our customer source through this channel. We remain committed to delivering consistent improvement across all key business parameters in spite of the challenges and a strong focus on sustainable growth, asset quality, and customer-centric innovation. As we move forward, we are confident in our ability to create long-term value for all stakeholders while staying true to our mission of financial inclusion. Thank you for your continued trust and support. And over to Harshit for question and answer. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jay Chauhan from Trinetra Asset Managers. Please go ahead.
Hello. Good afternoon. Thank you for the opportunity. So I just have one question, sir. You mentioned digital deposits have crossed 1,000 crore with a run rate of 3 crore a day. So can you just break down the customer cohorts driving this inflow and some important metrics like CAC and renewable data points that would convince you to scale marketing beyond the current partnership model?
Yeah, thanks, Jay. Currently, our digital sourcing on liabilities is on account of our partnerships with the payment banks, Fino, Jio, Airtel, and these are our key partners. And on the digital fixed deposits, which are completely granular, we source through various platforms, and the largest platform for us currently is Stable Money. And we are currently accruing around 3 crores per day, predominantly on the retail FD side. And the CAC is substantially lower than the physical mode, approximately around 35 to 50 basis points.
Understood, sir. And do you also calculate the renewable data points, I mean, and like customer lifetime value or something like that?
We just started in the last 6 months, as you know, that it was kind of a mode of almost doubling every quarter for the last 3 quarters. Currently, while we have 1,000 crores, it was less than 500 crores even a quarter back, which was last quarter. The renewals and all of that, we'll get to know the data only probably after another 6 months. But many customers, when they first test the platform, start with a very small deposit as low as around 1,000, 2,000 rupees and try pre-closing it to see the efficacy of the digital platform. Once they are convinced, usually then it jumps up to 50,000 to 1 lakh and up to around 2 lakhs. The customer profile of the digital fixed deposits are substantially different from the regular channel in that they are digitally savvy, probably have a credit score which is well above 750, and are people kind of who have diversified savings. Not all their fixed deposits in our assumption, this hypothesis, we'll have to test it later, really flows through a single bank. That's why usually the deposit size varies anywhere between 50,000 to 2 lakh rupees, and the average, I think currently we run at around closer to 1 lakh.
Got it, sir. Understood. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Good afternoon, everyone, and thank you for the opportunity. Sir, I had a couple of questions with regard to our secured portfolio. Now it accounts for more than 50% of our book. So how is this segment shaping up, especially given that the Q-on-Q improvement is there in PAR 30 book over there, which has come down to 4.3%.
Right. So, as you may have noted, Sailesh, the torch bearers for us is clearly CV and mortgage in that order. CV on a year-on-year basis has grown more than 50%. Mortgage has grown more than 30%. I think given the base that we have in both these businesses, our growth will continue to be quite high relative to what we plan to do in IF. And for both CV as well as on mortgage or on a 12 MOB basis, our PARs are well under control. So I think we will continue to focus on these two lines of businesses for our retail asset secured business growth.
So I wanted to understand if there are any early indications or signs, because various partners are talking about stress in those assets. So are we seeing any signs, given our exposure is on similar market like Tamil Nadu? So just wanted to have some color, anything on that front?
So, Sailesh, overall, indeed, we are significantly outperforming the market right now for a 1-year cohort or a 2-year cohort on both CV and mortgages. And it's too early because this static pool stabilizes in 36 months and anywhere between 24 months to 36 months. So last 3 years, anything post-COVID, the portfolio is intact, spick and span, and we had some incidents in the past in MP in mortgage. Otherwise, we are the portfolio post that is completely intact.
Okay, that's helpful. Coming to unsecured portfolio, year 2 in stage 2 we have seen a decline. Is it safe to read that slippages may have peaked during this quarter? And additionally, when can we anticipate 90 plus bucket to stabilize or potentially start declining?
Really, what we're really seeing, which is really kind of heartening, is that the rate of accretion to the NPA is coming down quarter on quarter. So we are kind of seeing almost the trend going closer back to what it would have been around 6 quarters back. So hopefully, if this trend continues, then it's near back to normalcy in Q3 and probably in Q4. The reason probably from some of the early SMAs would have come down is that the current bucket collection efficiency has inched up closer to around 98.5, 98.6, and fairly confident that the current run rate will cross 99 in the month of July. Given that scenario, some of the buckets would have been early SMAs would have flown on into GNPA, and our accretion in the current bucket is lower, and hence it's showing a percentage reduction.
So just to summarize, Q3 is where we are expecting slippages to come down meaningfully, right?
Yes, but Q2 will be lower than Q1. Q3, if that trend were to be extrapolated, I think it's a kind of a big assumption that we make based on, but at least whatever you're seeing, the ease with which probably the lesser the difficulty in terms of inching it from 98.5 to 99 gives us the reasonable confidence that if the trend were to continue, Q3 is where you will see a substantial reduction in the NPA accretion compared to Q1.
Okay. So my last question is with respect to our non-interest income. I believe a portion of it would have come from the claims during the quarter. So can you just highlight how it works, and additionally the remaining part of the CGFMU we are expected to receive this year around 250 odd crores. How would that flow into P&L and balance sheet?
Yeah, so there are 2 parts to your question. So on the other income, this year we made a little over 30 crores on PSLC, and we had a one-time gain from sale of our investment portfolio in OMO amounting to 13 odd crores, right? So both of them look to be one-off for the time being. We do not expect significant money to be made in PSLC for sure in the next 2 quarters. To your question on how the claim will impact our P&L, so what we see that all claims that we are likely to make in Q3 will be P&L neutral. It will help us reduce our headline GNPA numbers.
So basically, it would not be representing any return of pool, right?
Correct. Absolutely. Yes. All
And
claims
what would
will be in
that-
respect of NPA pool.
And what would be that amount if there is any change in that number?
We are expecting about 300 odd crores as the claim amount from our side in Q3.
Okay. Can I squeeze in last one more question?
Yeah, sure.
In terms of NIMs, we have seen quite a bit of pressure, I understand, because of high slippages and also because of book mix changing. Where do we see this settling, and what is the kind of guidance for future in normalized business?
So, for this particular year, we will look to have a credit cost of around 1.2, 1 quarter. On a steady state basis, we will be having, credit costs in just about near about 1%. Given the kind of mix that we have in the businesses today, we will continue to have the 55-45 mix between secured and unsecured.
Shailesh, this includes claims from CGFMU. If you can now adjust the premium for it and then add it up, it will add another 50 basis points or 60 basis points to the overall credit cost. If CGFMU premium paid is also treated as a credit cost.
I was actually referring to NIMs part because NIMs have kind of fallen that way. NIMs, net interest margins.
Yeah. So, we expect that our NIMs will be somewhere between of it on a steady state basis with the kind of mix that we have. But we will continue maintain this.
Sorry to interrupt, sir. There is a background noise. Hello.
Yeah, I was not able to hear them.
Yes, sir.
Is it coming from my side?
Yeah, I think so, Shailesh. Can you check, please?
Yeah, please. Is this better now?
Yeah. Can you hear us, Shailesh?
Yeah, I'm able to hear you now. Please.
Okay. So, like I was saying, we expect the NIMs to be in the region of, 7.5 to 8% with the mix that we have. We shall continue to maintain this mix of 55-45 between secured and unsecured.
Okay. Thanks a lot, and best of luck, sir.
Yeah, thank you.
A reminder to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yes,
Yes,
please.
sir, you are audible.
Yeah, thank you very much, sir, for this opportunity. So just first up, just wanted to know, this CGFMU portfolio, our 100% of IF portfolio is covered under this scheme?
Yeah, more than 98% of the portfolio is now covered under the scheme.
More than 98% of the portfolio?
Yeah.
Okay. Fair enough. And in terms of normalization of credit cost, we mentioned we expect normalization to happen from third quarter, right?
Yes, please.
Okay, understood. And in terms of Karnataka, we have any exposure?
Yes, we do have.
Yeah, 11% of our portfolio is Karnataka. So we have seen significant improvement in the current bucket collection efficiency right from February onward, and now it is more or less getting normal. Indeed, earlier Karnataka used to be the best state with 99.8, 99.7. It is maybe 1 quarter away to get into that earlier high current bucket. Otherwise, Karnataka is back to normalcy as far as we are concerned. And we don't focus on group loans anymore. We focus on individual loans, and we have changed our strategy 2 years back. We stated that the customer behavior has changed from group to individual, and we started focusing on the graduating customers from 2023 onwards.
Deepak, just to clarify, 11% is on the inclusive finance portfolio. Not on
11% of IF portfolio.
Perfect.
And we have seen significant improvement, and we see Karnataka is already back to normalcy. That's what.
Yeah. Near back to normalcy.
Of the current customers.
Correct. And any other state we are seeing any kind of issue? Stress?
Yeah. Broadly, I think other than Karnataka, whatever stress we saw, but what's not really kind of stabilized is that it is not gone back to 99.5 as it was about 6 quarters back. So it kind of stretches anywhere between 98.2 to 98.7, 98.8. So Tamil Nadu was seeing some stress. I think it has fairly stabilized, not really showing any more deterioration. What happened, and kind of the remaining current portfolio operates closer to, I would say, 98.6, 98.7%.
Fair enough. I got it. And just my last query from my side, I mean, given the direction we are seeing in terms of lower slippages and improvement overall across the sector, so would it be, I mean, right to say, I mean, quarter on quarter we should see improvement in our bottom line? I mean, whatever we have seen, that would be a base, and we will build upon that in coming quarters. Because if we have to reach 11-12% ROE, that is one trend that we need to might be looking at, right?
Should probably play out the way you're mentioning, Deepak. But what we do currently, including in our inclusive finance portfolio, slippages, we provide the entire amount, which is not claimable under CGFMU, which is approximately 23%. We don't provide 25% of 23, we provide the entire 23.5% in the same quarter as 27 in the same quarter. 73 is claimable. So to that extent, whatever, in a way, it's kind of an upfronting the credit cost of the portfolio, anything which is slipping in straight away at 27%, and the balance 73 is what is claimable, and as you know that it is with a cooling period of 1 plus 1 year, the year of origination, and then you have the crystallization year, and then the third year is when we make a claim. So to that extent, as we see more lesser and lesser slippages, 27% of that straight away will be our addition to our P&L. The current trend which you are seeing, of course, we will have to take into consideration, already 15 to 20% of the customers across board in the industry, and even to us, it's no different, is that already has slipped into the GNP. So what we are really talking about from now on is the customers who have been through including this stress cycle and have been paying reasonably well, and hopefully once it stabilizes at 99.5, things will be far different from than what you have seen in the last quarters.
Correct. And what was the slippage amount in first quarter in rupees crores?
Yeah, so we did around 278. We had 278 crores of slippages, as against 308 crores that we had in last quarter of FY25.
And do we expect substantial improvement in this number of slippage of 278 crores from 2Q onwards only?
Yeah, we certainly expect that. So we would want that, our slippages reduces anywhere between 50 to 70 crores in the next quarter and then the quarter thereafter.
50 to 70 crores. Okay. Fair enough. I think that's very helpful, sir. I mean, thank you very much. All the very best.
Okay, thank you.
Thank you. The next question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, sir. Good afternoon. Sir, out of the 584 crores which are receivable under CGFMU claim, so how much can we expect in this year and how much the next year?
So about 320 odd crores will be for this year, and the rest will spill over to the next financial year.
Okay. And sir, since the industry is facing so much challenge, is there a possibility that these claims, what we have done, some of them are rejected, or maybe the percentage on the claim will be reduced?
Well, what we kind of our CGFMU cover has not started post the crisis. We started when our GNPA was in this portfolio, IF portfolio was probably less than 2%. The mathematics at that point of time pointed that the premium will be substantially higher than the claims that we would make. But nevertheless, having seen a couple of cycles, every 4 years, known unknown factors cause it, like this time. So we kind of, I would call that as an investment, knowing fully well that it was not in terms of not to have a plan to have a claim more than the premium. We would have been happier even if the premium that we paid for consecutively 4 or 5 years would have been higher than the claims that we received. So our portfolio is covered at near 100% in the last 2 years. And to that extent, we don't, under the scheme is primarily focused in terms of ensuring that more and more households without formal credit gets included. And it's a well-funded scheme to our knowledge. So to that extent, as long as we are completely right, both in letter and spirit, and including in terms of a recovery, once claim, we do not simply write off the portfolio and leave it at that. There is a collection which happens as much as in the regular GNPA portfolio, including in this portfolio where the claim comes and that money is returned. We actually look forward to having a track record that of a substantial amount of the claims that we make, we are in a position to return it back to the credit guarantee fund by focusing on the collections as if it is our own. And I think hence we do not at this point of time, having made our 2 claims and getting the entire 100%, and we only ensure that what is eligible gets covered and that we are not cherry picking based on the risk of the customer, either in terms of stage or in terms of indebtedness. Across the board we kind of cover and do not see at this point of time anything significantly different as a claim amount received than what we make the claim.
Okay, that was helpful. So the 320 crores, what you are saying, we'll be claiming it in the third quarter or we'll be receiving it in the third quarter?
We already got 50 crores in Q1 as you
So our expectation is that, the claim will be fulfilled in third quarter. So we do see a reduction in the headline GNPA numbers by the time we report Q3.
And the day we claim, I mean, in how many months we receive the amount?
It would vary, but I think with the committed timeline the service will is around 60 days max.
Okay, so max by fourth quarter we can expect this 320 crores.
I wouldn't be able to kind of second guess for the fund, but the fact is that they make a claim till now, at least the turnaround time has been probably much lesser than the 60-day period which they kind of work on.
Okay. And sir, for current year, we are guiding for 1.5 to 1.6% ROA and around 12% ROE. So how confident are we to achieve it? And by next year, can we expect ROA to be north of 2.5%?
I think we'll cross this year with whatever we've really committed and fairly confident. I think towards the end of the Q4, I think with the key learning is that guidance works in a far stable environment. In a very dynamic environment like what we have seen, we would rather completely included in terms of ensuring 11 to 12 and 1.5%. As we kind of have that visibility fully clear, which should be by end of Q3, we will probably be in a better position to guide. That is what we intend. But to say that it will happen next year would rather be a little bit too early.
Okay. And so my final question, what would be our guidance on GNPA and NNPA number by year end?
Overall, I think we have guided for 5 and 3, but of course the timing of the CGFMU plays a critical thing. So it may be, but what it would be is that by and large we'll try to maintain the NNPA minus the CGFMU cover very close to 0%. So the rest of it will be mathematical, and hopefully towards the Q3, Q4 we'll also start seeing in terms of us getting even from the claims that we made and in a position to return it back to the credit guarantee fund.
Okay, so this 3% NNPA is after considering this 300 crore of claims?
No.
Before that? Okay, fine. That's it from my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Shashi Kapoor from Dauladhar Capital. Please go ahead.
Congrats, sir. Good numbers. Just wanted to know what kind of changes we are doing in our leadership team, or what kind of hiring are we, particularly in the top leadership team?
As we speak, I think we're fairly happy to state that the leadership team has been stable and the leaders who are here have been in the system for more than 3 to 4 years. That is extremely important in terms of ensuring a steady growth, aligned, effective leadership. So we'll probably have one addition to handle marketing and HRO and marketing specifically. Other than that, I think we're fairly on. I don't think we're really focusing in terms of we hired a senior leader for customer experience and we had hired a senior leader for retail liability products. So I think we are full up at this point of time, and the focus is in terms of ensuring that all of us contribute substantially to the overall growth of the bank.
Thank you.
Thank you. The next question is from the line of Rahul from Trellis Investment. Please go ahead.
Hello.
Hello.
Hey, hi.
So am I audible?
Yes, please.
Yes, sir.
Hi, sir. So, from a slightly longer term perspective over the next 2-3 years, how do you see the profitability trajectory of the secured lending business, such as housing finance or MSME? We have been active in this segment for some time. Like, I just want to know what's the broader vision in terms of that segment, because as we are shifting from unsecured to secured mix, so I just wanted to know that.
Rahul, as you know that no, we've never called out saying that we'll go towards 80% secure. There is a good balance that we would like to maintain. Ideally, we would have preferred a 50-50, kind of, very comfortable at 45, 55, that is 45, so-called unsecured, and 55 will be rest of will be secured. Initially, we have kind of taken a focus in terms of secured, both in commercial vehicle as well as in terms of mortgages, to be at a reasonably closer to the near prime segment. And as we really have a portfolio which is seasoned and fairly confident, slowly we'll kind of inch up to kind of do a little lower ticket sizes, where the profitability will be higher than what we have built up secured. And even within the secured, since most of it is business loans and not in terms of personal lab, the possibility of giving quasi-secured or semi-secured loan or unsecured loan is become substantially higher. We also become liability customers. I think now we have the leadership at the top level which handles mortgages and branch banking. We see quite a bit of benefit in terms of making customers on both sides of the balance sheet, which is both on the deposits and savings side as well as in terms of the lending side. Gives us fairly good confidence in terms of looking at a customer holistically and purely on a product basis. So it will stabilize, and we were very clear that the transition will happen in a way that the P&L is not impacted by excessively moving to secured in a very, very accelerated manner.
So one follow-up question. When I look at the investor presentation, these strategies that have played out slide, so looking at the strong growth trajectory in the secured retail segments like CV and mortgage, where the portfolio has scaled from around 1,000 to 3,800, like around 50% CAGR, along with stable GNPA levels, how do you see the profitability profile shaping up over the next 2-3 years for the secured business in terms of the CV and mortgage? Because additionally, what role will be the increasing granularity and geographical diversification play in supporting such returns?
Two ways in which we can really look at it. One, if you look at the portfolio already built up, cost of maintenance of the portfolio will be kind of substantially lower than probably, I don't have the exact number, say probably around 100 basis points. But if you look at the cost that we are investing, or the investment that we are making in terms of securing higher businesses, is what really adds up to the costs. Both the businesses at double the scale at which we are at this point of time will become ROA accretive to a point, to an extent of probably very close to 1.5%. And since you can consider this as a break-even to the ROA, we are kind of well beyond the break-even at this point of time in both the products. And specifically, if you look at only the maintenance piece of that, it will be pretty high. But both combined investment as well as the maintenance put together, inching up to ROA, will be when the portfolio doubles, which will probably be 1.5 years from now.
Okay, sir. Thank you so much, and all the best for the coming quarters.
Thank you very much, sir.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Siddharth Chandrasekhar from and retail investor. Please go ahead.
Hi, sir. Am I audible?
Yes, sir, please.
Sir, I have a question regarding our liability franchise. So I was going through our presentation. So we have a guidance for 40% growth in our deposit book. I was going over the the branches that we have also, right? So from 2021 we have around 550 branches around, and now we have around 700 branches. So what I could see is our incremental deposit book is not coming from our branch growth or employee growth, right? So what is our where we are getting our business amount of growth? Because the industry-wide phenomenon is basically 10% or in good case it's 15%, right? So could you elaborate our what is our strategy to get this excellent amount of growth in deposit side? So you alluded to the fact outside third party sourcing is just 1,000 crores, right? So I guess the remaining 90% is from our own side. So what's driving this factor?
Sir, I'll let my leader Gaurav answer the question. But before that, the fact is that we are now present only in approximately 130 of our overall branch network in terms of focused on deposits. Slowly we are kind of enhancing our all other branches also to become deposit focused in a smart balanced manner. We also started what we call as smart banking outlets, which are 300 to 400 square feet, surrounding our main branches to cater to the big neighborhoods. Digital is incremental, and now over to Gaurav to state.
Yeah, as Bhaskar mentioned, I think there are a couple of things, apart from the digital space, wherein, of course, in the last 6 to 9 months, we are seeing great results coming in. I think apart from that, I think what is helping us is the investment we have done in the last 2 years in terms of manpower. I think instead of, spreading ourselves very thin, currently we're just about 130 while we grow. But I think the objective has been to kind of go deep into the current geographies and, of course, look at the enhanced productivity on the retail side. So I think that is something which I think, has worked for us, and we kind of, plan to continue for the next 2 to 3 quarters.
Also, Mr. Siddharth, our base is not very high now. We're just about around 11,000 crores and not. So to the extent, the kind of the mathematics in terms of the figure will little be higher.
Okay, so whatever growth that we are capturing is basically from our account holders, right? These are not, just accessing customers just for deposit.
Yeah.
It's primarily retail granular. So 80% of our deposits are granular retail deposits.
Okay. Yeah, thanks for the clarification. I have one more question regarding our inclusive finance book. So what I could say is I appreciate the fact that we got CGFMU for our insurance coverage. So that's a commendable job. But excluding the fact that, right, so if I see the performance of that specific book and if I compare it against the peers, what I could say is maybe ours is not the worst, but still I can say ours is not still not the best of among the peers, right? So where exactly we were wrong? Because in COVID also our GNP spiked a lot, right? And now also our GNP is spiking a lot, right? So there is some pattern some of the peers got impacted in first during COVID time, and now they are a little stable. But our book got impacted heavily on both occasions, right? So what are our learnings from here, and what we are trying to change to make sure that this does not happen again?
Sir, well, kind of this is something which has to be seen at a little longer basis. So I do agree that when COVID it was a little higher, basically because we are either because of geographical concentration. But we're also very clear that this is not a customer segment where you fund it and you kind of go and collect somehow. So sometimes even on a personal basis, when you go and meet the customers, there has been a health crisis or there has been an economic crisis, irrespective of whatever pre-analysis that you do, when they kind of get into that, it's not collected at any cost. So we're reasonably proud that in terms of any complaints, in terms of the way we handle collections in the inclusive finance segment, we have not gotten into this business and are not in this business only from the point of view of high yield, high return. So there is a balance which we kind of exhibit in terms of the way we collect. And given that probably always the damage may be a percentage more than 2. But I think increasingly what we are really seeing is that including from our GNPA customers, we are able to see a collections coming back as long as we are in touch with the customer. There are certain percentage which is migrated or for circumstantial default moving to intentional default over a period of time. I think we would probably like to work on a model where can we really treat these customers with a far more responsibility, and that be at some of the times when you do a 90 plus and then write off, it's probably not the customer is not wanting to pay. We lose touch with the customer. This, I think, one clear learning this time we have taken, and we'll attempt to do it, is that be in touch with the customer and be in touch with the customer, and I'm sure that will kind of translate into a better collection efficiency, including for customers who have stepped beyond the GNP. Thank you.
That's all from my side. Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities.
Hi, team. Sir, firstly, can you just share the microfinance slippages number, please?
Okay, so out of the 280 crores of slippages that we have at the bank level, 240 crores is on account of microfinance.
Okay. Sir, and can you share some qualitative commentary on the situation on the ground today, specifically in terms of borrower leverage and how the market is performing in terms of disbursements?
Shashi?
So overall market has slowed down in terms of disbursal. So you can clearly see muted portfolio across. Players like us who are focusing on the graduating customers and continue to play and continue to grow. So we have gone back to the more or less same disbursal numbers of Q1 FY25 as this quarter, and our individual loans have actually become now 2/3 of our overall IF portfolio. So we can clearly see the market is having a challenge on the group behavior. So the group model, like Bhaskar has called out a couple of years back, group model has inherent inbuilt operational challenges now at a design level, because earlier in a group we used to have 12 to 15 members minimum. Most of the groups used to be more than 15, and the economies of scale, productivity used to be there, and there was a good meeting point for the customers to come and gather on a given a day in a month. Now it's no more the activity, and there are 20 plus lenders in most of the pin codes. So that's the primary thing. Market is definitely moving. There are always, even in the worst of the times, 80% of the customers are good. So we just need to pick and choose the customers. So from a qualitative point of view, internally we have clearly focusing on graduating customers, and not only existing customer Suryoday graduating customers, but also MFA industry graduating customers. So our NTB Vikas loan started from the month of January. Now we have built a portfolio of almost 200 crores of NTB Vikas loans. It's too early. However, bounce rate is low single digits, and we continue to collect all the money through standing instruction in the savings account.
Got it, sir. And specifically around the household leverage situation, how do you see what is the situation of those borrowers which you would have probably stopped disbursing or would have flown to NPA because of higher leverage? Do you see those customers also getting access to any credit at this point?
Yeah, for some reason, this is something we have been taking in the internal MFI forums. Customers continue to get lending, not necessarily in the same name in the household. So that's the fundamental challenge, and there are also challenges of during a significant period lending was done on Aadhaar numbers, and when we put voter ID, the match doesn't happen. So customers continue to get loans.
I think there are some of the operational challenges of the industry which the industry is working on. MFIN is working on in terms of unifying and clearly identifiable unique number for the customer. It is not Aadhaar at this point of time. So we'll have to come up with, there has been some requests made, including MFIN requesting for whether we can use the last 4 digits across. Some will come in, but at this point of time, we'll have to play prudent in terms of where there are credit bureau track record of 2 of the people at the household level. It's up to each institution to play the risk. And with the overall, however, the guardrails too is getting implemented. We certainly will see some benefit. The so-called slippages would be slippages. It's better to have those slippages upfront than the liquidity kind of flushing that out. So we'll see some little bit of a moment there. But overall, I think it has been very good for the industry, and I think everybody is clearly appreciative that while it is at the cost of a little bit of a business drop in a couple of quarters, it's going to probably help us in terms of building a solid portfolio. More important than that, the word spreads around saying that only good customers will get funded. Probably earlier, if I'm defaulting to X, but as long as they're good to me, I can go and fund. The new guardrails really kind of put a cap on that. That I think will be a good behavioral change for the institutions in the microfinance segment as well as for the customers.
Got it, sir. And just lastly, when you do acquire a borrower or offer a repeat loan to a borrower, do you think it is viable enough or viable enough to check the bureau report, bureau history of all the members of the household? And do you do it?
See, there is a legal angle as well. So I can't really kind of take a credit bureau of all the members connected. To the extent they are coming into the deal structure, it's kind of not done. It's the applicant and the co-applicant because they sign up for it. But mostly these are the 2 main earning members of the family. So yeah.
From April 2023 onwards, it is mandatory to collect the co-applicants' KYC details. So the entire industry collected. So we have collected, we have got the bureau track of the husband or the earning members of the household. So we have a significant data as far as our existing customers are concerned.
The viability of doing assessment Now I think at least with all that we have seen in the last 1 year, it's much cheaper than to really enter and then encounter a credit loss across the sector.
Okay, sorry. Just to confirm, you do check the bureau history. You are able to check the bureau history of the applicant and co-applicant.
All of us, I think, do.
Okay.
That's my understanding. Yeah.
Okay, understood, sir. Thank you.
Thank you.
A reminder to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Yeah, thanks for the follow-up. So I have a small confusion. You just mentioned to me that by year end we are expecting 5% GNPA and 3% NNPA. Is my understanding correct?
Yes, please.
And this 320 crores which we are expecting in Q4, this NNPA is without that 320 crores.
Yes, that's correct.
So can I?
So basically the claim that we will get from CGFMU goes to reduce our headline GNPA numbers, right? So as an example, if let's say if I have 100 rupee of NPA, I am already carrying 27 rupee of provision, and when I get the 73 rupees claim from CGFMU, I use the provision and the claim to write off.
Okay.
Otherwise, our NNPA is actually today also nearly zero, and so whatever guidance we have given is before considering that CGFMU claim. Otherwise, today also, if you consider CGFMU claim, although the GNPA is 8%, 9%, but NNPA is nearly zero.
Adjusted NNPA.
So and since we are providing 100% for the uncovered portion, it essentially means that my net NPA is entirely covered under the guarantee scheme.
Understood. Okay. Thank you.
Yeah. Yep.
Thank you. Ladies and gentlemen, as there are no further questions, I now hand the conference over to the management for closing comments. Over to you, sir.
Yeah. Thank you very much for taking time and participating in our conference call. Thank you very much for your continued support. Thank you.
On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.